Hey, what's up everyone? I'm sure you are loving the cash flow statement right now, and we've got a whole nother video just for you. So let's get started. So in this video, we're going to dive more deeply into the investing and financing sections of the cash flow statement, and then talk briefly about subsequent events and how we adjust or don't adjust our financial statements for things that happen after the end of the year, but before we actually issue our statements. So just as a reminder, our cash flow statement is meant to reconcile our cash balances between the beginning of the year and the end of the year, so we understand where our cash inflows came from and where our cash outflows went. So in the last class, we talked about the operating section in depth and how to do the indirect method. And in this class, we're going to get into those investing and financing sections. So our investing section primarily collects kind of three types of transactions. Those are purchases and sales of PP&E, purchases and sales of investments, so things like equity or debt securities, and if we lend money to other people. And for purposes of our class, these are the only three transactions you're going to see that actually hit the investing section. There are sometimes other things that companies will do in the real world, but we want to keep it kind of simplified here. So these are the three categories you need to keep in mind when you're creating an investing section on a cash flow statement. So if we take a look at Nike's 2019 cash flow statement, the investing section, there are kind of three important things that I want to point out on this. First of all, if you look at those line items, we see investments and we see PP&E. So we have a huge multinational corporation and they're kind of, using the same categories that I just pointed out in their investing section of the cash flow statement. Two, remember that the investing and financing sections are both what we call direct method. And so we're not reconciling some number like we did with the indirect method in the operating section. We are just listing direct cash outflows and direct cash inflows for these activities. And third, we list these direct cash inflows and outflows separately. So we have short-term investment lines where we have an outflow for the purchase of investments, and we have a separate line for the inflow for the purchase of investments. And it's the same for PP&E. We have one line for the outflow for the PP&E we buy, and we have one line for the inflow for the PP&E that we sell. And finally, we add these things up and we get the total net cash flow for our investing activities at the bottom. And in this case, a positive number is cash provided by our investing activities. So we sold more investments or sold more PP&E than we spent. And a negative number is cash used by investing activities. And so that's if we had a net cash outflow for these types of activities. So PP&E can get a little bit tricky on the cash flow statement because different PP&E items can kind of go to different sections of the statement. You're going to have a little bit in operating and a little bit in the investing section. So I want to clarify where these things go and the calculations you might need to go to kind of create these sections of the cash flow statement with PP&E transactions. So assuming we're using the indirect method in our operating section of the cash flow statement, when we buy a piece of PP&E, we're spending cash on that thing. That cash outflow is going to go in the investing section, just like we saw on Nike's cash flow statement on the previous slide. Now, we hold this PP&E, and what do we do over time? Well, we depreciate this stuff. Now, the depreciation goes as an expense in our income statement and lowers our net income. So when we do the indirect method, depreciation is one of those super common items. You're almost always going to see that in the indirect method, that we have to add back to net income in order to reverse that non-cash expense out of the operating activities, because we already took care of the cash outflow for the PP&E in the investing section. And so we want to take out this non-cash depreciation expense out of the operating section. So we add depreciation back to net income. Now, it gets even more complicated, unfortunately, when we decide to sell a piece of PP&E, because there's going to be kind of two pieces to this sale. We're going to have cash inflow, and the cash we receive from the sale, that goes in the investing section. That's kind of the easier piece of this. We're also potentially going to have a gain or loss on the sale. So if the book value of our PP&E was, say, $100, so let's say we bought it for $200, we depreciated it for $100, and so the net book value is $100. If we sell that thing for $150, we're going to have a $50 gain. If we sell it for $50, we're going to have a $50 loss on that PP&E. Now that gain or loss is going to go to net income. And because we already recorded the cash inflow for the sale in investing, we want to reverse out that non-cash gain or loss from net income up in the operating section. And so if it is a gain, that increased our income, so we want to take that thing out. So we're going to subtract out a gain from net income in operating. And if we sold it at a loss, that's pulling down our income. So we're going to try to add that loss back to net income in the operating section. So I know there's lots of different signs, adding and subtracting, and can get kind of confusing. Just remember the investing section takes the actual cash I pay for PP&E and cash I receive for the sale. And the operating section is used to reverse out all the other stuff. So it reverses depreciation and it reverses any gain or loss on the sale. So let's walk through a few examples so we can hopefully solidify this intuition around the purchase and sale of PP&E. So let's say we have Luigi Tires and they have a few transactions with PP&E, and we're going to want to ask what is the journal entry they record and how does this affect the cash flow statement. So let's suppose they buy equipment for $10,000 in cash. Well, this is going to result in an increase in PP&E and an outflow of cash in our journal entry, right? Credit cash, cash goes out, debit PP&E, PP&E goes up. The $10,000 out is going to go in the investing section of our cash flow statement as a cash outflow. Nothing else at the time of purchase hits the cash flow statement. Now, let's say they're using this equipment and they depreciate this thing by $5,000. So we're going to debit depreciation expense for $5,000, and we're going to credit the accumulated depreciation to bring the asset value down by that same amount. Now, we already recorded the full $10,000 cash outflow in the investing section, right? And so this extra $5,000 of depreciation expense, which is dragging down our net income, we're going to call that a non-cash expense. And we're going to reverse that thing out of net income up in the indirect section of the operating section of the cash flow statement. So to reverse out an expense, we have to add that expense back. So we're going to add back $5,000 in the indirect section. So now the most complicated piece when it comes to selling this thing. And we're going to see three scenarios. One where we sell it at no gain or loss, one where we sell it at a gain, and one where we sell it at a loss, and figure out how we deal with these things. So let's suppose Luigi sells this equipment for $5,000. The first thing we have to do is calculate the gain or loss on the sale of this thing. And so remember, the calculation for the gain or loss takes the cash we receive, in this case $5,000, and we subtract the net book value of the asset. And as a reminder, the net book value is the cost of the asset, in this case $10,000, minus the accumulated depreciation, in this case $5,000. So our net book value here is also $5,000. And so if the cash we receive equals the book value of the asset, we have no gain or loss. So when we sell this equipment, we get rid of the equipment with a credit to the cost. We get rid of the accumulated depreciation with a debit to that account. So this $5,000 we receive goes in the investing section as a direct cash inflow. If they sell this equipment for $8,000, we're going to have a net book value of $5,000 still, but we're receiving $8,000 in cash. So because we're receiving more cash than kind of the book value of the asset, that's going to generate a gain for us of $3,000. It's kind of a good thing, right? Selling it for more than your book says it's worth. So when we record this entry, we're bringing in $8,000. We still get rid of the old asset and its accumulated depreciation. And we record a credit to a gain of $3,000. That's going to increase our income. So the cash inflow of $8,000 still goes to the investing section. But now we have this gain. We've already taken kind of care of all the cash inflows and outflows, right? When we bought it, cash outflow went in investing. When we received the $8,000 for selling it, that also goes in investing. And so this $3,000 gain is something we're going to call non-cash. So our net income now is too high compared to the cash that we received from operations. So we're going to reverse out that $3,000 gain by subtracting $3,000 from net income in that indirect method operating section of the cash flow statement. Now we'll do the reverse if we sell this thing at a loss. Suppose we sell it for $4,000. Well, that's not so good, right? We thought it was worth $5,000 on our books. We sold it for $4,000. That's going to generate a $1,000 loss on our income statement. So when we, sell this thing, we still bring in $4,000 of cash, and that's going to go directly to the investing section. The cash we receive, direct cash inflow. But the loss that's dragging down our net income, we're going to call that thing non-cash, and we're going to reverse that out of net income in the indirect method operating section of the cash flow statement. So we're going to add back the $1,000 loss to net income to kind of take net income to our cash received from operations. All right, so I know that was a lot. Thankfully, the financing cash flows are actually quite a bit easier. We just have transactions with our creditors, our lenders, and we have transactions with our shareholders. And again, financing section is direct method, so it's just the cash we borrow or the cash we raise in terms of equity, and it's the cash we pay back to our lenders or the cash we pay back to our shareholders in the form of dividends or stock repurchases. So if we take a look at Nike's financing section here, we see these categories, right? We see them borrowing money, we see them paying money back. Again, those are split onto different lines in most cases, and we see them paying dividends and we see them repurchasing stock from shareholders. Both dividends and stock repurchases are just returning cash to your shareholders. It's just in slightly different ways that have slightly different tax implications. So you don't need to worry about that stuff. Just think of them both as returning cash to our equity holders. So that's a financing transaction. Now, one of the interesting things here is they actually net their change in notes payable. So instead of kind of the borrowings they make from notes payable and the amount they pay back for notes payable on two separate lines, they're netting those things together. And my hunch is that's because they have a whole lot of, really big inflows and outflows. Maybe they're borrowing and paying back money every single day. So the gross amounts of those, the gross borrowings and the gross amount they pay back is extremely large, even though it's just a whole bunch of, kind of daily transactions. So in some cases, when you have these really big gross amounts, we're allowed to net those together. And then finally, we total these things up just like the investing section, where in this case, the negative number is a net cash outflow from financing activities. So we're going to call that cash used by financing activities. Okay, so the last topic we're going to cover kind of briefly here are subsequent events. So sometimes what happens is the fiscal year end will kind of come to a close. Say that's December 31st, but it takes a while to prepare and issue the financial statements. Could take 1 month, 2 months, 3 months, anything like that. And things can happen in those 1 to 3 months, such as, the sale of a component of the business. They could issue debt or equity. There could be a fire that burns down a factory. They could settle litigation, right? And this is all important stuff to the company, but it happened after the end of the year, but before they issue the financial statements. So we need to figure out how are we going to deal with this stuff. So our basic rule is that if the event occurred after the year end, we're just going to disclose it. We're not going to change our financial statements in any way, except say, hey, this thing happened. But if the event occurred prior to the end of the year, but say we didn't learn about it until after the year end, then we're actually going to adjust our numbers to reflect whatever the economic gain or loss was from that transaction. Okay, as a quick example here, let's say on January 30th, 2021, Sarge learns that some inventory that they'd sold to a customer, that customer is not going to be able to pay them back, not going to be able to pay what they owed to Sarge. And the inventory ended up burning down in a warehouse fire after the customer took possession of it. So Sarge isn't going to get anything out of this thing. And so they have to decide, do I adjust my financial statements for this loss of inventory and this loss of AR, or do I just disclose that this fire occurred? And so like I talked about, kind of the decision process here is, when did that fire happen? If it happened, say, January 15th after Sarge's year end on December 31st, then we're just going to disclose that it occurred. But if the fire occurred on December 1st, 2020, sorry, I had to make a little adjustment there, which is why the 2020 looks a little funny. There was a typo. If it occurred on December 1st, before Sarge's year end, but Sarge didn't learn about it until, say, January 30th, they are going to go ahead and adjust their financial statement numbers to incorporate that loss into kind of their income statement and balance sheet. So, quick closing thoughts. The investing and financing sections are direct method cash flow statements. So that means we show the cash we pay and the cash we receive. Now, when we buy and sell PP&E, we record the cash outflow in investing and the cash inflow from the sale in investing. But we're always going to reverse out the depreciation expense and any gain or loss on the sale from net income up in the operating section of the cash flow statement. So those we're going to take out. We're going to call those non-cash. And finally, we're going to adjust or disclose subsequent events that we learn about after year end, where if the event occurred before the year end, we'll go ahead and adjust our accounting numbers. If the event occurred after year end, we're just going to disclose that event in the financial statements. Thanks for watching.